Welcome back to the channel, everyone. Today I want to talk about how big funds and major banks are experiencing massive liquidity issues, not just as a result of the market crash, but also as a result of investor withdrawals. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, JP Morgan investors have handed Jamie Dimon a rare rebuke with disapproval over his $52.6 million bonus. Just 31% of investors participating in the New York-based bank's annual shareholder meeting voted in support of a $52 million award that was part of Dimon's 2021 compensation package. The bonus in the form of 1.5 million options that Dimon can exercise in 2026 was designed to keep the CEO and chairman at the helm of JP Morgan Chase for another 5 years. Now we know that so far in 2022, most large hedge funds and major banks are down on the year. They haven't made investors money this year. So far, they've lost their money. Obviously, over the last 10 to 15 years, investors have enjoyed gains every single year, some years with much larger gains than others. Obviously, in 2020, 2021, the S&P 500 was up over 10, 15, 20, even 25%. Over the previous 10, 15 years, there have been smaller years, but usually the S&P 500 has at least been up, say, 3 to 5% per year. If I pull up the table for the yearly gains on the S&P 500, we can see that most of the years over the last 10 to 15 years have seen gains of upwards of 9%, sometimes even as high as 19, 26 or 28% per year. Therefore, each and every year, apart from in 2018, investors enjoyed massive returns on their investment every single year. And therefore, over the last 10 to 15 years, investors have not felt the need to withdraw their money from large funds and these major banks because they've always been making money. But so far for 2022, obviously the S&P 500 is down 14%, and therefore this is the first year in a long time that investors are losing money. And not just losing 1 or 2%, but losing nearly 15% of their entire investment. And therefore, as a result, many investors aren't happy with Jamie Dimon receiving a massive fat off $52.6 million bonus, and obviously instead are thinking about withdrawing their money from the markets. Now we know there's a number of large hedge funds that have been experiencing massive amounts of investor withdrawals so far this year. Citadel have actually had to restrict investor withdrawals. Everybody in Melvin Capital wants out, and I'm sure there's a number of other funds like Tiger Global that are also experiencing massive withdrawals. It's got to the point now where it's literally safer for these investors to withdraw their money from these large hedge funds, drive to the local gas station, fill up some canisters with petrol or with diesel, and literally leave them at home because at least that way their investment will appreciate. As a result of many of these large hedge funds experiencing massive amounts of investor withdrawals, the likes of which that haven't been seen since 2008, many hedge funds are struggling with liquidity issues. It said the disapproval was the first time JP Morgan's board suffered a downvote on compensation since the pay watch measures were introduced more than a decade ago. Which, as I said, is fairly obvious because the losses that we've experienced so far this year haven't been seen in long over a decade since around 2008. I think more and more this year we're going to see large hedge funds and major banks suffering even more losses. Now obviously those investors in those large hedge funds and major banks aren't going to be happy. Those investors aren't going to be happy losing all of their money and therefore aren't going to be approving the pay packets of the hedge fund managers and instead are going to be withdrawing their investments. And speaking of which, Softbank's Vision Fund has posted a record $27 billion loss as tech stocks have plummeted. Also guys, be sure to sign up to Moomoo using the link in the description below to get up to $17,500 in free stocks. Moomoo and Futu have also officially announced that they do not accept payment for order flow, and therefore Moomoo is brilliant to buy those AMC shares. Moomoo is also very easy to use and it's incredibly customizable, and that's why Moomoo was awarded the award of being the best trading platform. Softbank's Vision Fund posted a 3.5 trillion yen loss, or $27.4 billion, the biggest loss since the investment fund began back in 2017. Now, in terms of what kind of percentage loss that is, Softbank actually has two funds that have a net value of $154 billion. The second fund is worth around $30 billion, and therefore the first fund, that Vision Fund, is worth $124 billion. A $27 billion loss is around a 22% drop. I think when the Vision Fund was founded up here in May 2017, it started life as $100 billion. And therefore, over the last few years, it's increased from $100 billion up to $124 billion and now back down to around $97 billion. So it's erased all of their losses over the last nearly 5 years. And I'm sure when many investors are losing their entire gains over the last 5 years, it's obviously not very encouraging, and I'm sure many investors will be wanting to withdraw their money from yet another fund. And as Zero Hedge has also tweeted, housing is now starting to crack. MBA mortgage applications are down 11% versus up 2% last month. Again, housing purchases are down 11.9% versus 4.5% last month. And also refinances are down a further 9.5% versus 2% last month as well. And therefore across the board, mortgage applications, property purchases and home refinances are all down by around 10%. Obviously, it's very worrying that housing is also starting to fall more and more and more as the months progress, and it wouldn't surprise me if we also see a housing market crash or a property market crash at the same time as the stock market is also crashing. Mac10 also tweeted about Walmart's biggest 1 week drop since Lehman Brothers. Now, I think this is really important. Walmart is obviously one of the largest companies in the entire market and employs more employees than any other company in the entire US. Walmart is obviously a staple of every single person in the US, and therefore for the company to suffer a loss in line with the amount that it lost during the Lehman collapse really shows that the market is really struggling. Consumer sentiment is also nearing an all-time low, just as the Walmart stock has been plummeting. But obviously not wanting to be outdone, Walmart posted its 11.4% biggest one-day decline since 1987. But Target has just stepped through and said, guys, hold my beer. Again, Target is another giant company and a massive staple for a US consumer that's down 25% or was down 25% so far on the day. I think this is a clear sign that inflation at the moment isn't just numbers on a page or numbers on the internet. It's impacting every single everyday American, and price rises are being seen across the sector, especially in the household consumer market or just in supermarkets. And Wall Street Silver has tweeted a chart of the 2008 crash plotted against the current S&P 500 movements over the last few months. In grey here we have the 2008 financial crash, and on top of that in blue we have the current S&P 500 movements over the last few months. The current S&P 500 is almost replicating the 2008 recession perfectly. Yes, we do have some pullbacks in 2008, like we're seeing right now over the last few months, but after every single minor pullback, looking like the S&P 500 is about to run to new all-time highs, it then crashes further once again. And something I found really interesting is that Britain's inflation rate has just surged to a 40-year high of 9%. Now, I found this really interesting because back in March, the UK inflation rate was only 7%, and therefore between March and April, the UK inflation has increased dramatically from 7% up to 9%. Obviously, if we compare this to US inflation, between March and April, inflation actually declined from 8.5% down to 8.3%. Now you may ask, Tom, why has the UK inflation rate gone up massively but the US inflation rate has actually fallen? And to be honest, I don't really know the answer for that. Bloomberg have reported that in the UK, the leap from 7% inflation in March up to 9% inflation in April came from an increase in energy prices. They've said fuel prices also contributed, as did the war in Ukraine. Now in the US, we're also seeing an increase in energy prices, fuel prices also increasing, and the war in Ukraine is also impacting the US just as much, even not more. And therefore it's very interesting that these exact same worldwide impacts that are impacting both the UK and in the US are having vastly different impacts on the actual inflation numbers, increasing from 7% to 9% in the UK, but somehow decreasing in the US. I think it's very possible that the US CPI data has been dampened down as to try and not cause too much panic and fear in the markets. I'm very interested to see what happens when the May inflation data is released, whether we see an increase from April or further decreases due to the interest rate being raised over in the US. Obviously, the Fed has announced that they need more and more rate increases through June, July, and August to obviously further increase that US base rate. But again, similarly in the UK, the Bank of England is also increasing their base rate from 0.1% already up to 1%, but yet inflation over here in the UK seems to be getting worse. So guys, be sure to leave a comment down below and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.